So, very good evening to everybody. Let's start with our April month call. Now, I just want to quickly recap also what exactly we have said in January. We have been making presentation for last 2, 3 months on various forum. What exactly we are talking about, how market has played out, and how we look at way forward. Okay. So obviously we are celebrating this year 30 years of Quant Mutual Fund, and we are also celebrating because we took over a 96 established mutual fund, and we are also celebrating 30 years of Quantum Mind. This is some analytical tool or platform which we got built right from 1995. From my house, we started, and we have invested $24 million in building this analytical tool. So just to give you perspective, and okay. Now, obviously, in today's context, when we're talking about market has been very volatile. Every day we have seen wild swings on the market. So let's understand how market implied analytics are endorsing about market, where we stand in terms of money flow analytics, where we stand in terms of volatility analytics, and how perception has, whether it's deteriorated for equities and India in particularly. We'll try to address some of these points in this presentation. This is a very famous Jacob from our side. I just want to remind, how beautifully something which was written some in 2012 has played out. If you notice out here, we talked about how geopolitical volatility will spike from end 2019. And if you notice from 2025 onwards out here, though volatility will start drifting down, but it becomes more red. And we have seen the side effect, what happened from 25 onwards. Okay, so it's a fairly good perspective how market implied analytics some 12, 13 years back were able to predict how the geopolitical volatility will pick out, because no way you can predict a geopolitical volatility. Okay, with the movement of crude, which we can visualize and forecast with the movement of gold or any other asset classes, you can interlink and then you can forecast geopolitical volatility. And this is something which we have been doing it reasonably well. Okay. Now, 2026 perspective, we talked about in the beginning. This is year where more dynamic and adaptive asset allocation will be more apt for the current year. And if I have to recap what we said in January and February call and how exactly. So we talked about two things, fragile 2026 and P contraction year for 2026. This is exactly on various channels, forums we talked about, and so is the case in monthly call also. I just want to recap and you see how exactly it played out. This is the first slide which we have showcased in the beginning January. We said that geopolitical volatility will remain elevated in 2026 without understanding that this Iraq-Iran battle will start so soon in the month of February itself. So this is the way fragile 2026 we talked about. We talked about the currency DXY from 96 is now close to 100 mark. So we talk about a cyclical uptrend to start, but structured downtrend. And even we talked about beginning year, how precious metal we will see extraordinary volatility. In multiple forum, I said this year gold and silver will behave like a cryptocurrency, and it did the same manner so far in last 3 months. Okay, crypto will make new high and new lows. We have seen new lows very recently, and new highs are pending. If you have to recollect, we also talked about the beginning January that we'll see sharp volatility spike in the crude prices. Okay, the spikes in Q1, and we said very specifically Q1. Okay, how in Q1 due to geopolitical volatility spike, and I will cover it separately in the next slide about where we talked about crude, which is an important subject right now. And we talked about how P contraction, US vulnerability, some of the areas which we are looking at that point in time. Let's let's recap the precious metal. This is something we talked about extraordinary volatility in 2026. Like silver, this year also we expect silver will be outperform, but the gap will be slightly narrow because we expected more correction in silver, which has played out. And we also have, generally, we don't give ranges. This is the first time in various forum we showcase these ranges. So we're talking about closer to 5,500 on the higher side and 4,400 on the lower side. We have seen very both the ranges, and I will not be surprised to see 3,800 mark also. But we were quite lucky in that sense. We were able to book profit gold at 5,500 in our multi-asset fund and on the mutual fund scheme side, and silver around 111 level. And we are now looking for an opportunity to rebuild some exposure at appropriate time. We have not added. Since then, we are running bare minimum 10% requirement of sit. And that too, earlier we were running 30% silver. Now we are running around 10% gold. So bare minimum gold we are running right now. But we still believe both precious metal, both invisible part of precious metal should be part of your core portfolio thesis. So from that point of view, we remain constructive. But we believe in January 2026, we have seen a top for gold and silver for both for 2026 perspective. And it could be even from a medium term perspective, but let's not, it will be too mature, premature to talk about something like this. Okay, now let's come to the gold, particularly crude and natural gas. This is what exactly we highlighted about and thing. Now, very interesting, important aspect we have to look at. We also try to capture the how the geopolitical volatility is one aspect, how the crude own volatility is going to play out. In fact, the crude volatility data has actually spiked to nearly 190% and now came down to nearly 90%, which has become nearly half from the recent peak, which clearly endorses that smart money is not factoring very spiky or elevated prices of crude from a longer term perspective. When I say longer term perspective, next few months or few quarter perspective. And that's the reason I'm taking a bold call that by end of December 2026, crude will come back to the original level where it started. So I'm expecting below 70 price on the NYMEX crude, it will come down. And if I have to really look at these ranges, we talked about 120, 129 sort of thing. I'm still not ruling out one more spike, though in the crude market and the spot market, we have already seen closer to 140, 141 mark levels. But if it has to retest, it will retest in this month itself. So we expect that April month will be the most high level of crude will be in play. That's what the market implied analytics is endorsing. But as of now, the trend is slightly up, and we think it can remain elevated at least for this month and then gradually subside. So we are again now nobody can forecast these things how the geopolitical volatility since we track crude very closely. So we are able to quantify with the help of market implied analytics where crude is heading. And this is what in the month of January, February, we said that crude volatility will spike, prices will move up, and this has happened. So if that can be forecasted, this view can be also mathematically endorsed. So this is something which we want to talk about. Natural gas is more from a US point of view. Asia gas prices are very, very different. So I'm just trying to skip that aspect because and frankly speaking, the challenge in India is also about LNG on LPG front. Crude, we don't have that challenges because we are getting continuously supply from Russia, so it's not impacted up to that extent. Our vulnerability is more on the LNG side and LPG side, and that's the way current situation is slightly awkward. And given the forecast which we are talking about, that crude has potential to correct now, which means logically this war also should subside. It is premature to say it'll get over. The Ukraine war is still going on, but the relevance will be lost. And that's the way data points are showcasing. So I will go with the data-driven thing because we as a house believe that data is God and objectivity is a religion. Data is God. That's the way we define this whole thing. So we are based on these analytics, we are trying to give some perspective how we see markets. Okay. Now, this is a part of the currency aspect we talked about. We said only Swiss franc and JPY will be the two currency will appreciate against dollar, and most of the global currency will depreciate. It has thesis has played out quite well. The the biggest risk which we highlighted about the dollar index spiking, and yes, it has rallied 5% or so, but still not moved up to that extent, which was our visualization. So that's a good news for the emerging market. If dollar could have rallied significantly, then it could have been bad news for the emerging market in particular. Now we still believe that even this month also, the XY also has potential to peak out and has a high probability of start correcting happen, which means emerging market has a potential to outperform the developed market. This is could be the important conclusion we can draw, and provided dollar index don't spike, and as of now it's unable to move that much levels or not able to spike up to that extent what it should have done. So that gives me a ray of hope. that emerging market has potential to spike. So we can watch these levels very closely. Now, coming to the global equity, then I'll come to India very briefly. So this is what we have talked about, how peak contraction phases will happen. And we said that the way we talked about that India risk appetite peaked out in July 2024 and we turned negative on India. A lot of high frequency macro data was also deteriorating, and we endorse that we have seen a peak in global in Indian macro, and since we talked about correction and something similar we said in the month of January that we are seeing something similar in US market and something similar we spotted in Korea and Taiwan in the month of February 2026, which means these markets are showing signs of complacency. And whenever you people are very complacent and data points is against you, means this means the vulnerability is very high. And that is the background which we still believe for the global market. So, and as a reason we talked about P contraction, and we have seen this thesis has been playing out quite well. And even talking about the deterioration happening on the Magnificent Seven, we talked about how AI related noise will, which is there a lot of hype got built, is also corrected. Now let's come to the quickly on the India aspect. So this is a big question which people was asking whether India has potential to outperform both on relative and absolute basis, because India has been underperforming for nearly 8 or 10, 12 quarters. We have been underperforming not only in emerging market, we are also underperforming the developed market. So it's a concern which a lot of foreign investors have with us, and particularly on the FPI side, we have seen a massive outflow. And let's talk about April onwards, how the situation will be. So we have a very strong view, and this is some other slide we'll talk about. We think India absolute outperformance will begin from April 2026, and that's the thesis which we think. Sometimes it's very difficult to pinpoint the exact date, exact time, but if you have to say either beginning of April 2026 or maybe by end of 2026, something, these are some of the behavior reading which we can conclude from various data or the analytics which we do. This is something about what is market is endorsing right now. So which means it's a time to increase your equity exposure substantially. And this is some of the various slide we talked about in March, beginning uh, April 2026. So we are now in that phase where this thesis has more legs, and something which we have seen in last 3, 4, despite the noise and narrative has only increased, crude had spiked, but Indian market has performed extremely well in last 3 or 4 trading sessions. Okay. So when we talk about broader thesis on relative outperformance, is the larger thesis which we believe. Now I'll come straight away to some of the points which we are believing that what exactly is going to play out. So let's in our recent fact sheet also we talked about this is time to capitalize the opportunity and not to capitulate, and where best of the investors are getting worried, we are seeing capitulation or vomiting ground sort of thing happening in the not only the large cap and mid and small also. The equity market cap also has Indian equity market cap also has corrected significantly. And if I have to draw down few things, we are seeing signs of capitulation in the broader market. I'm not saying that it is across the board, but closer to 75% of data point is endorsing we are closer to bottom. Either we have already seen a bottom or we are very close to that bottom. Not 100% data point, which means certain sector and certain stocks have definitely bottomed out. And this is the ability now how well we can capitalize this opportunity. So I expect a pullback rally in the month of April, but keep in mind that it's a small pullback rally, and then even if market has to correct and come back to retest those old levels, it will all happen in April itself. That's the way we think that April 2026 should be remembered as a bottom for Indian equities. Okay, relatively bold call, but this is what our data is showcasing. We were early in 2024 to take a risk off call, and we are seeing early signs of risk on call for India, not on absolute basis, but initially on the relative basis. So relative basis, we think it has opportunity despite all noise and narrative which we are seeing. An important call which we want to make out here, that we have seen extraordinary money flow in last few quarters in the gold and silver, the precious metal space, and the ETF market. And in the January, we said that this space is peaking out. We are actually making another important call saying that gold will underperform Indian equities. I'm not talking about gold outperforming underperforming the global equity. That call we have not able to arrive. But if I have to say with good amount of confidence, then gold and asset class will underperform India equities. A very important thought process which we thought will highlight, because a lot of people are putting a very sizable money in the ETF market and the gold and silver side. I think we should be slightly more cautious. Time has actually reversed where equity market will start outperforming. So this is an important thesis I thought I'll highlight. Another thing is also about the small cap will outperform gold decisive. Okay, when we're talking about SMIT as a sector, as giving signs of capitulation, and India equities will underperform, will outperform the gold. And within the equity space, the small cap will outperform gold decisively. So with the gap between uh, this underperformance and this outperformance will be so meaningful that if somebody has the 3 to 5 year perspective, even 3 year perspective, I think a decent alpha can be made by reversing the trade which people are doing it for a while. And we expect under owned stock or under ownership, not only from the FI perspective, but even from the domestic mutual fund perspective, the under ownership should play out quite well. Now, if I have to relook at what are the potential sector, if I have to talk about very clearly, we are looking at the in the current context, let's understand what to avoid. Now, nobody is clear how long this war can last. It will be our view that should peak out, gold should peak out, crude should peak out by April end, which means ideally things should settle. But given the uncertainty and vulnerability, we like to avoid large exposure in the manufacturing in general, particularly where you have concern about the raw material. We are not very clear the inventory at both the prices. And second thing also on the logistic challenges some of these companies can face. So slightly worried on that part. And hence we are relatively under owned manufacturing. Obviously, you can't have significantly underweight on the manufacturing and significantly overweight on the uh, services side, which is not will give you a very balanced approach. Hence, we have decided to remain underweight. We cannot cut down completely. So our focus is now large infra names. Energy, we are significantly overweight, 20-30% sort of exposure we have, depending on which schemes we're talking about. Data center is a thing. AI implementation could be a new theme which can emerge. Pharma generic is very clear indication. Even today, whatever noise was there in last 2 days about the extra duty of 100% coming on the formulation, generics are completely absent. Media entertainment, the sector is very small, but it's giving early signs of bottoming. Is a classic neglected territory or most hated zone where these stocks are trading. So our entire focus is to how to identify relatively under-owned, undervalued stocks in these sectors, and we try to see how best we can generate alpha out of that. Now, if I had to really look at from a positioning point of view, we were revamping our portfolio for a while, and then this is what we believe the 90% of the exercise is largely over. We had a large private sector bank. Today, we are significantly overweight on the NBFC, which is not the case historically. You see, last our 5 years portfolio, this is the time only where we have very sizable exposure, and it is actually helping us because if challenges you are facing on the manufacturing side because of this uh, war which is going on, we have our own challenges. So we have very large exposure in the private sector bank, insurance, asset management companies, some other wealth management companies. We have proven down our real estate and PSU bank exposure. We have increased our pharma, generic side, healthcare exposure. We have increased our consumption space, and particularly in the FMCG. And we are rebuilding our mid and small portfolio in the recent fall. That's a broader approach, which what we have done in our portfolio. And so this is all about how we look at the market. Okay. And obviously important change happened on the regulatory side. STT changes has happened. We're talking about on the regulatory changes happening. SEBI has allowed us to add precious metal in any of the equity scheme. So it's the call people take, whether it's a diversification or creates more confusion. We think it's a good risk management tool. And if you can time it of these products. Good, this can be add actually as a great risk management tool. So we are pretty happy about that part, and we will able to capitalize some of the opportunity. I'm not going to take much time on this. Let's skip to the, this is some of the presentation. Let's, important thing, we are also launching our, rather launched our active asset allocator qsif. Okay, scheme is just open on second and will close on 16. I want to talk about something on multi-asset strategy. I just want to give you my perspective on these multi-asset strategies. When we started Quant, lot more distributor and people have asked me which will be your flagship scheme. Okay. And that time we were very small, 27, 30 or 180 odd crores corpus, total corpus. So I said that multi-asset is a, will be our flagship product. Okay. Now that's the time people were slightly amazed to know that multi-asset can be done and people have never thought of. Now, if you really look at why I talk about multi-asset, because given the volatility in the market or sometime extraordinary hype also, when a money manager get a flexibility to not only to switch between sectors and stocks, but also in asset classes, he or she will able to do a great job and generate superior alpha with limited risk. So risk adjusted returns will be always going to be better in the anything related to multi-asset strategy. And I strongly believe this category has grown a lot in last 1 year because of the precious metal space. Uh, People are attracted. But from a risk management point of view, it's a brilliant product. If you ask my personal assessment, I think this will be next 10 year will be bigger category than the flexi cap. So that's the perspective which we bring on the multi-asset side. And what is very unique is that people are, the schemes are gaining traction. People are trying to understand that in, and particularly in last 2 years, how equity markets has underperformed, particularly in the India side, not globally. And this is an area which we want to highlight. I will cover some of the performance part also in the next few slides. So how we are positioning this product very clearly, we are trying to showcase three minds, but obviously one fund. So we are talking about how well we can capitalize cross asset, cross market opportunity. And this is something which is trying to explain. It's as a money manager, we have a huge flexibility to combine. And obviously, from an equity market perspective, not only the earning multiple or earning momentum we can capture, we can talk about rotation, sector or stock rotation thing, mispricing related thing, debt market, obviously yield curve, credit spread, duration risk and look at. And the commodity is very, people will understand the importance of commodity that you can actually understand and read the regime changes. Okay. The geopolitical thing which we saw very recently, the commodities market gives you a very good reflection. If you have a deep understanding on the geopolitics side, then the commodities behavior and the linkages between the global commodities and the global currencies plays a very important role in understanding the geopolitics so well, which is the hot topic right now. Okay. Now, purely from a long short perspective, obviously, in the mutual fund side, we do have a long multi-asset strategy. But what is advantage here? Here we are also talking about additional feature of having 25% naked short. So we are calling it a long short multi-asset fund. We all are familiar with multi-asset fund and hence we calling it long short multi-asset fund. It'll give you a fairly good perspective that over and above how we have a benefit of multi-asset strategy along with the naked option, naked short option available to us. So it's very important when you talk about active asset allocator long short fund. What we are talking about is not just diversification. It's also about it's just intelligence. How well you can bring these inflection points together and that intelligent you're trying to highlight, how what is your ability to shift money between various asset classes. That is something is your intelligence and which we do with the help of our predictive analytics, something which we always try to highlight and how we're able to showcase in terms of extreme situation how well you can play. This is a phenomenal product from that perspective. And obviously a grandmaster approach for a diversified growth. Now, why we are saying this is the most unconstrained investment strategy across SIP and the mutual fund space. Okay. Now, even SIF has more flexibility on the shorting side. You can generate actually alpha also by shorting, but it also have some restriction that you have to play within a hybrid category which is well defined or the equity is well defined. It's only in the active asset allocator you have 100% flexibility. And that's the reason we are saying this schemes or this type of scheme. So QSIF active asset allocator will be the most unconstrained fund in the industry. And we are highlighting the unconstrained aspect. Unconstrained has to be looked from a flexibility we as a money manager get, since we as a house largely specialize in the macro side. So when we think this unconstrained approach really help us, and we always write in our investment philosophy, active, absolute, and unconstrained. So this is one of the reasons we think this is the most unconstrained fund, and we are harping a lot on this subject. But as a money manager, we get a flexibility. Now, what exactly you can do? Obviously, objective is very clearly superior beta management. What difference between mutual fund and SIF in a very simple terms? It's a better beta management product. If you can create 25% naked short, assuming that your entire portfolio beta is one, let's say for a hypothetical example, then you are talking about the moment you take 25% short, it becomes 0.65. So we are able to cut down the broader market risk or the exposure risk you can able to cut down, not necessarily the volatility. And it is a possibility that you may lose money both on the long side as well on the short side. But from a risk management point of view, it really helps. So this is the some of the strategy which we want to talk about, how this product is played out. And we have option to invest in the cash equity arbitrage 35 to 65. Since this is the other taxation route, we don't have to maintain 65% equity exposure at any given time. We have to maintain only 35%. And that also 35, we can run through arbitrage. So effectively, we can have 100% hedge exposure on the equity side. We can have similar 100% hedge from the commodities on the and the debt side. And over and above we want, we can have a 25% naked short exposure. As of now, short exposure is only allowed in the derived aspect of both equity as well as debt. Commodities is not allowed, maybe at a program regulatory will allow the same thing. So this is a one important difference you should understand how this is playing out. Now, this is small description in terms of what exactly we will do in terms of how the equity exposure will play, how the market cap agnostics will play out, how the fixed income. We have tried to explain the same Excel sheet which we have just shown. This matrix we have tried to expand a bit to give you more clarity how exactly, because a new product for the industry. And a lot of simple questions were asked, whether it's what type of product is a mid cap, small, large cap. Yes, we can invest across mid and large thing. Basically, it's a flexi cap sort of approach within the multi-asset allocation. So we can manage the equity portion with a flexi cap approach. Yes, we have option to put in the commodity, the not only precious metal, we can put money in the other commodities also. So that is also a great opportunity. The challenge which we industry face, most of the large custodians are not ready for having doing a clearing as well as settling the trade on the settlement side, between the custodian side, they are not ready, and that's a big challenge industry is facing. We also have made some changes, and I hope in next 6 8 months time, couple of larger one also will start this activity. One of the reason volumes are relative on the lower side. Once activity picks up the mutual fund, this segment also we want to expand. How what happened in silver in last few months, we have seen extraordinary volume, extraordinary activity, which is not the case a year back. Even to buy 500 crores of ETF in the market used to be a challenge. The impact cost was very meaningful. This is some of the questions we have tried to explain, that you can have 100% hedge exposure, still you have 25% short. Okay. So some of the basic things we have tried to cover out here. Okay. Now, so it's a nice way of presenting a multi-asset strategy at your fingertips. Okay. And give you. Now let's talk about why Quant. Okay. It's a very important thing. If why we believe Quant as a house is very well positioned to capitalize multi-asset strategies. Okay. Now we as a house, we talk about Quant Global very uniquely capture some of the macro data. We invest sizable money, and every year we spend $1 million in building some of these analytics platform. So some of the important thing is that our understanding on macro is through very pragmatic approach. Okay, one approach is that like today's context, whole world is talking about crude will rise and no brain trade, crude will rally. Okay, but where we are coming out and saying that by end of the year it will not be at these levels, and maybe April month itself will give you indication that should we have seen a top in the month of April itself. Now it requires, it's not a gutsy call, it's a data-driven call. So the data is saying, and that's the reason we as a house, with the help of our predictive analytical tools, which we combine a lot of cycles and backtesting data thing, how well we understand the linkages between various cycles, how this cross asset, cross market strategies has helped us in last many years. And I'm going to explain you, showcase some of the live performance also, how exactly play out. So we have quant multi-asset strategy in our mutual fund scheme. Now, multi-asset strategy funds are has been redefined known as multi-asset allocation fund. So this is the track record of our mutual fund performance. And we have tried since we started our VLRT framework during COVID lows from in March, April onwards, we implemented these strategies. So it'll give you a fairly good perspective how what is the point to point return for the direct scheme. We have tried to give you an example, say, which has delivered 432% by end of 31st March 2026. So it's a 6-year performance nearly, where benchmark has given a multi-asset benchmark has given 197%. So we have given an outperformance of 235%. Okay. It is even we compare the Nifty 50, then outperformance is very substantial to 54%. Even you compare the with the mid and small, even this product has outperformed the, just one second. Yeah. This product has outperformed the mid and small also. It has outperformed the small cap by 66% and even mid cap by 81%. So it's across all category how Quant multi-asset allocation fund has done. And in last 6 years, I'll also show you from a perspective what it has done in last 1 month, 3 months, 1 year. Even look at last 1 year perspective or last 3 months, which has been very challenging for the industry. It has outperformed the benchmark. So by 4.22%, which means it has fallen significantly lower than the even multi-asset benchmark, which itself is slightly more conservative as compared to these schemes. Even 1 year, it has given outperformance of 8.6%. You look at even 5 years, the outperformance itself is 15%, is very large. We have given a CAGR returns of nearly 25%. So it's a very commendable performance which is there. And this is some of the thing if you have put 10,000 rupees, how exactly that numbers look. And very interesting data I just want to highlight. Let's look at one more data points. Again, no comparison, but just trying to give you perspective within the entire industry, how this fund has performed. So within the multi-asset category, in 5 years, we are number one, 3 years, we are number one, and 1 year, we are number three. This is an absolute thing we have pulled out. It's not a just a understanding point of view. It gives you perspective how the strategy is played out. In the small caps, we in 5 years is number one. It has beaten our own small cap. It has beaten our index itself. And within the industry, it is the best performing. Mid cap is number one in 5 years. Large cap number one in 5 years. Flexi cap number one. Large and mid number one. Multi cap number one. ELS is number. Value categories be number one. Focus is number one. DAF it is number one. And we have 268 thematic funds. In 5 years, a third best performing fund within the thematic also. It is a very good performance which we want to showcase out here. It's not just to give you a comparative perspective. You just from a education point of view, how this strategy has played out well. And this is the gaps which you see in last 6 years or so with the multi-asset fund as well as Nifty. Look at the gap the quant multi-asset allocation the mutual fund side has given. It give you a fairly good perspective. And we have tried to explain how we capture the gold silver ratio and try to look for opportunity, why we able to sell gold and silver virtually at the peak of the cycle and how we build increase the exposure at the beginning of the cycle. This is the all the performance from a regulation perspective here to disclose all the performance because money managers are common 3 months, 6 month, 1 year thing. Even we have given the link also if you want to see with more clarity. It's there because this is a compressed data of all the schemes you have to put in one screen, but there's a link is given, and so the link is also provided to an on the riskometer side. This is the performance how our liquid index side has done. This is the performance how the qsif various product has done because money managers are common across the board. So it'll give you fairly good perspective. This is exactly how the investment process revolve around setting our multi-asset allocation fund, which is the something similar we do another few setting. Only thing, the strategy changes a bit. Okay. Now, these are some of the things which we want to talk about on the what is exactly going to play out the investment process. I'm not going to get into details, but because you largely understand that. So just for a academic point of view, and you can go through it. This is something similar. We can talk about how the process will be on the commodity side. Okay. And this small portion I explained the arbitrage. And obviously, we always talk about this question comes whether qsif to be should be looked in isolation or we should sell my mutual funds. And we always say you should add to your existing mutual fund portfolio or even your equity portfolio because by combination, we always say it gives you lower volatility, better diversification, and you get a first time additional source of alpha through shorting route because a lot of people have considered when the moment you say shorting is considered the more risky because ultimately we have to understand derivative instruments are actually a risk instrument. It helps you in protecting your downside. But SEBI does not allow us to take any leverage exposure. So, which means the risk is also not there. The moment you add leverage to your derivative exposure, the risk is on the higher side. Okay. So, this is some of the advantage of thing which we have covered in the previous presentation. So, I'm not going to get into more details. You can just go through the entire presentation and this is how the differentiation will be used with another thing. I'll stop it here and I will take few question answers. Okay, so this is a small data. You can just go through it. I'm not going to repeat because this is what we have covered in our previous slides, previous QSIP.
Um, Thanks, Sandeep, for the detailed presentation and very exciting market views. So maybe I have a couple of